So with the cautious consumer front and center, let's get right to our floor show traders for cautious consumer stocks. We're joined by John Gagliardi and Scott Fullman. Scott, give me your picture at 30,000 feet first, and then how you view stocks that would possibly work well even as the consumer remains cautious.
So, Liz, it's really interesting. We've been talking for a long time, as you know, about the connection between oil, the consumer, the markets, the economy. And the fact is that today's consumer confidence index really bears that out. Consumers really getting cautious here. They're backing off. They're changing their spending habits even more dramatically. Why? Because oil is so high. And even with taxes being reduced on oil and gas products, the fact is that people are still paying a lot more now than they were a year and a half ago. So we've been cautious on the market. We have stayed cautious, and we're being defensive and being in those defensive sectors, such as consumer staples as well as healthcare. One of the stocks that's really been jumping off the screen for us has been Chef's Warehouse. Has really exploded over the past several days. And also, we're looking at a couple of pharmaceutical companies, Merck and Bristol-Myers Squibb, both of them showing some nice relative performance here. And you got to follow where the relative performance is if you're going to outperform the market.
Well, and as you look, John, at what Scott not only has articulated, but what the market is telling us, specifically Nike. I mean, Nike's earnings did not impress. The stock is the laggard on both the Dow and the S&P 500 at the moment, down about 6.7%. And you see exactly what happened here. They did beat on the top line, on the bottom line, rather, but the revenue came in as well, pretty decent. It's just a matter of why their outlook does not look healthy, and that has a lot to do with what happened in the rearview mirror, China. But China's reopening. That's partly why the markets opened higher this morning, because China has relaxed a lot of their quarantine rules now for travelers who are coming into the country. So isn't today precisely the time to buy a name like Nike?
Now, during times of Fed tightening, there are certain sectors that just won't do well. And retail is one of those sectors. Consumer discretion, that's where Nike falls. That's one of those sectors. But there are green shoots out there, and there are some really bright sectors. If you look across the Fed tightening cycle and what's supposed to do well, according to the textbooks, it's supposed to be things like healthcare. And inside of healthcare, we're seeing things in biotech starting to settle down. And biotech is starting to find a bit of a base, and it's been a just brutal 2 years of selling. And that's where we're starting to see some of those green shoots. And as Scott said, if you want to be in stuff that's outperforming the market, you have to find stuff that's outperforming the market.
Yeah, true. Scott Fullman, we are watching ahead for two numbers: consumer price index, which gives us an indication of inflation at the consumer level, and producer price index. Same thing, only for manufacturers. That comes before the June 27th Fed meeting. What do you suspect happens here ahead of that?
So, the thing is, again, we're probably going to see more signs of inflation. Inflation really has not backed off. Look, gas is down, what, maybe 15 cents a gallon, 20 cents a gallon. It's not enough to change consumers' outlook on things, and they're planning for going forward. We got the back-to-school shopping season coming up, and then the holiday shopping season. And we think consumers are going to be looking for deep discounts this year because basically they're changing their spending habits, and they don't have that disposable income that they had before.
Yeah, and Walmart is a laggard here. Kohl's, Target, Macy's, Best Buy, all of these retailers are in the red, anywhere from 1 to 4.7%. Yeah, Best Buy is obviously involved very much in tech, and we were talking about tech. John, do you like tech at any point, and what is the green light that you are waiting to see in order to say that's a sector I would pile into?
Now, that's the problem I see in all of our investors. I talk to a lot of investors every single day. And the thing that I'm hearing over and over again, they're looking at what has done well for the last 5 years. And they think it just has to continue to do well forever and ever and ever. And the lifeblood of any bull market is sector rotation. And unfortunately, the things that have done well for 5 years don't necessarily do well in a recession or during quantitative tightening. So it's a double whammy for things like retail, tech, semis, software. They're all leading the charge down. And that's a moment to rebalance. It's not a moment to panic. It's not a moment to freak out. The S&Ps are not going away. We're going to see the S&P still around. The names will change.
Yeah.
And your job is to either index and have somebody manage it for you, or you have to take the reins and do some of that management yourself. And management's a hard job.
John, Scott, thank you. I'm just checking the Dow just a minute ago. We then punched into an even deeper negative number here, down 483. Low when we started the show was a loss of 477, so incremental losses here increasing